are increasingly looking to collateralized loan obligations as a way to diversify their portfolios. AM Best has issued a report to discuss this growth in the asset class, and joining us now is Ken Johnson, Senior Director, and Jason Hopper, Associate Director of Industry Research and Analytics. So, Ken, insurers nearly tripled their holdings in collateralized loan obligations from 2012 to 2016. What is fueling that increase?
There's a couple things that are causing that rise, and although there has been an amount for the industry that's gone up, it's primarily concentrated in the top 15 groups from which we can see that still represent about 2/3 of the overall exposure to the CLO market. But as far as what's fueling it, a lot of cases we're seeing companies that have asset managers that they either own or are part of their organizations, and so they're really self-originating their own deals and then placing part of that deal into the insurance companies. Outside of that, the asset managers are heavily marketing this asset class to insurers, and they're selling it on 2 points, basically, based stronger yield versus alternatives in the market, and the fact that it's got a very low default rate from a historic standpoint. And I think what the insurers also like about it is it's a diversifying asset because the names that they're going to get through a CLO are generally not the names they're going to be able to find in the corporate bond market. And it also gives them a floating rate asset, which protects them a little bit from a rising rate environment.
Jason, market volatility has been the rule, not the exception, since February. What makes CLOs better equipped to withstand volatility and risk?
Well, they are not completely immune. There is some market risk, but they do have some favorable features. Kind of backing up a few points that Ken had just made. CLOs are floating rate instruments, so they do provide protection against the rising interest rate environment, which we might be seeing over the next couple years or so, which ultimately reduces the interest rate risk of these investments. And secondly, as Ken had also mentioned, risk performance in terms of defaults are better than their corporate counterparts. And this is because that the underlying loans are secured, which allows for better recoveries than corporate bonds.
So in 2016, 97% of CLOs held by insurers were investment grade. But the number of rating units holding below investment grade holdings nearly doubled from 2012 to 2016. Why that increase, and will it continue?
I mean, those points seem startling on their face, but there is more to meet the eye to that. Only 1 in 5 of our rating units actually has exposure to below investment grade bonds. Further, only 4 of our rating units have exposure more than 5% of their capital in surplus, with the largest being about 10%. So it's not a major concern, and it's definitely not throughout the entire insurance industry. Now, we have seen a downward shift in credit quality. That's more so from NAIC 1 to NAIC 2, and that's because there's a pretty decent bump in yield between those two rated securities. In terms of below investment grades, nearly 2/3 are rated in NAIC 3, so you're not really looking that far down the credit scale, again, alleviating some concern in terms of credit quality. Generally, CLOs are higher quality than other types of structured securities held by insurers, and we do expect the current credit quality trends to continue. However, we don't think there's going to be any cause of alarm in the near future. But I guess overall, investing in CLOs does require extensive research and knowledge. Many insurance companies have investment shops that can easily navigate through the corporate bond space or the private placement space. But CLOs are a little bit different in terms of their structure and the underlying overall loan analysis. So those are 2 nuances that some insurers may not have in-house and therefore need to look to outside investment managers for. At the same time, costs may become an issue for some smaller players, so that is somewhat of a barrier to entry as well.
So, Ken, this asset class is under pressure despite extremely low number of defaults among the senior tranches. Will the spread compression affect demand or yield?
I think it will, and I think it has to that effect. And there's kind of a short-term view of that and then a longer-term view for the most part. So CLO yields are generated from the underlying collateral, and at the time and currently, that includes primarily corporate loans from banks. And those loan spreads have been coming down over time, and it's impacted the pricing on new CLOs, but it has also caused existing CLOs to be repriced And the downside to that, insurance companies who bought these investment-grade tranches are not getting the return that they thought when they bought the paper. So, and that benefit is actually accrued to the equity holders or the more riskier tranches of those transactions. But what this has led to is now the underlyings are changing a little bit. They're allowing second lien loans to go into that pool of assets, which are a little bit riskier. And a bigger trend has been a substantial increase of the use of commercial real estate loans into the underlying pool. So you would think that, well, those loans generally go into the CMBS market, but the real difference is in the CMBS market, that's a 10-year market. It's generally a fixed rate asset. When they're used in the CLO, it's generally a shorter-term loan. Think of it as maybe a bridge loan to a developer. They usually have a higher loan-to-value attached to them. So there's potential for more risk to be in the underlying structure of the CLOs. As we move forward, we've kind of been in a benign credit environment, and various constituencies have tried to call the turn of that market, but for the most part, we really haven't seen any evidence of it. But I think we believe that probably sometime at the beginning or to the middle of next year, we might see that credit turn. And what that really means for the CLO investor is primarily that they will start to see more losses than maybe anticipated when they bought the CLO. But at the end of the day, it's still going to be a relative value choice for them. As long as it seems to be the right investment vis-a-vis what else is available to it, we may still see some leveling off, but still some activity there.
Great. Ken and Jason, thank you for speaking with us today.
Thank you.
Okay.
To view the full report, visit aminvest.com. For AM Best TV, I'm Meg Green.